Hi, everyone. Welcome to ETF 360. I am Cynthia Murphy, investment strategist at TMX VettaFi. And today I'm joined by John Kim, co-founder and CEO of Reckoner Capital Management. Reckoner is a global asset management firm with specialized expertise in alternative credit, which has been a big area of the market. I'm really excited to welcome you, John. Thanks for joining me today.
Hi, Cynthia. Thanks for having me on.
So let's set the stage. Let's talk about the current state of the CLO market, especially in the ETF category. We've seen not only steady inflows into the CLO ETFs, but we see this general interest in alternative credit continue to grow. What do you think is driving this investor demand for the alternative credit and CLOs specifically?
Well, I think, look, it's pretty clear that for a long time, the individual investor, the wealth manager, et cetera, have, had fairly standard options in fixed income. If you were pursuing a sort of 60-40 equity bond strategy, you had corporate bonds, some treasuries, maybe a few other things sprinkled in on the fixed income side. But as institutional investors know, there's a world of credit assets that are, far beyond what's happening in sort of IG corporates and sort of regular way bonds. And some of those more, what used to be more exotic options were actually sort of better investments. CLO bonds are a good example of that. They've had really wider spreads than standard corporates for a long time, but they've also had better, default and loss performance. So when you combine those types of metrics into one type of bond, it only made sense for retail investors ultimately to want access to those. So I think that's driving a lot of the move from regular way fixed income portfolios and standard bond portfolios to things that are a little more alt focused.
Well, in the ETF space, the CLO category is still relatively young, but we've seen a lot of new entrants trying to carve a lane in that category, especially in the AAA tranche, which is the highest quality tranche. Do you think we are reaching or have reached saturation from a product perspective?
Well, I think, look, certain strategies are probably reaching or getting close to the point where we don't need a ton of other options. I think AAAs are probably the best expression of that. I mean, we've got one really large fund in the market and several sort of medium-sized funds in the market. And the strategies realistically are not going to diverge that much. So you'll see a clustering of yields around that particular strategy. So I do think there's a certain point at which the market probably doesn't need a ton of other options, unless they're bringing something new to the table. So we're CLO ETFs as a whole, right, are still a very small percentage of the outstanding bond market in CLOs. So there's still a lot of room for growth in CLO ETFs generally. But certain areas or certain strategies might be getting to the point of saturation just because people already have great choices out there to invest in.
So this is ETF 360. So let's talk ETF. You recently brought to market the Reckoner Leveraged AAA CLO ETF, ticker RAAA or RAAA. Tell us what makes the fund stand out in the category. What makes it unique?
So our fund did bring one new thing to the market, which was a turn of leverage on the portfolio. Now, just to put that in context, because some people, hear leverage and they go, ooh, like there's a lot of leverage. This is a very modest amount of leverage meant to enhance the yield slightly. In a very, sort of painless manner, if you will. Like we're going to dynamically manage the leverage on behalf of the fund. Now, to put it in context, if you're an institutional investor, let's say that you are, a large hedge fund or you're a big asset manager and you have a AAA CLO bond portfolio, banks will lever you, sort of $5 or so to the $1 of equity that you're bringing. So they will lend you something like 80%, 90%. Against your portfolio because banks recognize that this is a very, very safe asset class with an incredible performance history. They're not that bothered about lending a fair amount of cash against your portfolio. Now, in our case, we're only taking 50 cents on the dollar. So instead of getting 4 or 5 turns of leverage, we're using 1 turn of leverage. So it's a very modest amount of leverage meant to enhance the yield slightly. So I think the benefit is we are trying to bring an institutional strategy to the wealth market. We're trying to do it in a very safe manner. And what we'd like to do is, take an asset class that we already feel is very, very strong, has great spreads, great asset performance history, and just use a technique that is very commonly used in the institutional markets and bring that to wealth managers and individual investors.
So, John, let's lean a little bit heavier into the leverage conversation. I love the concept of leverage that doesn't add a lot of risk to a strategy because we tend to associate one thing with the other. How do you manage this leverage aspect of the portfolio and think about in terms of how do we equip an advisor to explain to a client how this leverage is managed and how it's implemented here?
Right. So we have basically, think of it as a leverage facility that we have available to us, and we can draw down on it to buy new assets whenever we, get a certain pool to a certain size. So the idea is that when times are benign, when we're sort of just chugging along as we have been for the last couple of years, we can sort of ramp up the leverage a little bit and buy a few more assets to increase that yield. So effectively, you'll have more assets working for you in those times to produce yield, and the net asset value will sort of remain the same, but you'll have an increased yield coming to that net asset value in the fund. When things get rocky, when things go sideways, credit spreads are blowing out a little bit, and there's more price volatility in CLO AAA bonds. We anticipate bringing down the leverage to a slightly lower level. That will just sort of protect the NAV, make sure that everything's very good in the portfolio, things are going well. To that end, right, another thing I should mention with regard to leverage is we are only buying AAA bonds, not even junior AAA bonds. So sometimes bonds are segregated into senior and junior pieces. We'll buy senior AAA bonds. Those are the most stable, the most liquid, and have the least price volatility of the other classes. So when we dynamically move the leverage up and down, we're doing it, we think, on a base of very, very liquid assets that are going to have pretty stable price stability over time.
I love the thoughtful process here. So your firm, Reckner, the specialty is alternative credit. So, tell us a little bit about how your team is uniquely positioned to manage strategies like this. There's expertise you bring to the table here. Like, give us some color on the firm behind it.
Yeah, so we've got a lot of people here who spent large part of their careers in CLOs, either on the sell side, structuring, trading, arranging. So we know CLOs very, very well. We've been on all sides of the trade. We were actually in our previous shop a very large equity investor as well. So we invest up and down the stack, including in the equity. So we do know the product very well. We have a long history of sort of investing in this product. AAAs are just a great area of the stack to be in right now. And our expertise allows us to sort of, we know all the managers, we know the market very well. We see all the bonds, and we sort of have great access into what's going on, with portfolio managers and what they're seeing in the loan market, the underlying loan market. So I do think that we can bring our expertise to bear on this. We do have pretty strong opinions on CLO managers. It's really informed by data and sort of over time. So we've got to know people and understand their styles of loan management. But yeah, that's what we're bringing to the table, is a real expertise in this product. We are not really a large ETF shop that's issuing, a whole host of ETFs to cover every single asset class. We are specialists in our asset class that are seeking to bring that asset class to the market in different wrappers for people.
Yeah, and what's great about that is I love the very clear value proposition, which is, I think, a great way to position a product. So for folks out there considering the CLO space, considering our AAA, the ticker of the ETF, give us a flavor on what you see, what are your expectations for the CLO market, let's say through the end of the year or next 12 months, a little bit of an outlook.
The CLO market is very, very hot right now, as are many asset classes in credit. I do think that one interesting thing we've been talking about in our investment committees is what is the macro event that's going to occur in the next year or so that could potentially widen credit spreads or cause the market to sell off a little bit. And as we all know, look, the market's at an all-time high. Many credit markets are at an all-time high as well. However, I don't think anyone would deny that there's a lot of macro risk, right, that's embedded in the markets right now. There's a lot of uncertainty, a lot of different things that could happen and could go wrong, right? And because things are so, perfectly priced right now, there's not a lot of room for error. So if you have cash to put to work, and everyone does have cash to put to work, you need to put it somewhere, right? You can't sit there in money markets and make below treasury yields for your cash. Where are you going to put that cash such that you're making a decent yield, but you also are not going to get completely whipsawed, if things move the other way? And I do think that CLO AAA bonds satisfy a lot of the criteria that people would want, right? If they were drawing up a perfect asset to sort of, ride this period out for a little bit and make some yield. CLO AAA bonds have to be in that discussion because their price stability over time have just been exceptional. These are the types of assets that people sell first when things go wrong because they've had the least price drop. That's happened with banks, and that's happened in the UK gilt crisis a few years ago. These were the assets that were that would require the least amount of actual realized loss if you sold off a decent amount, and they're very liquid, so you can really move them and get the cash in the door if that's what you need to do. So we view it as a very defensive asset as well as a high quality sort of yield generator. So if you're worried, which we all, I think, sort of are, we're sort of watching the market tick up, and we're happy about that, obviously. But you're also a little bit more worried than you were before, just because things could go wrong, right? If you have that kind of take on the market right now, this is really a great asset class to sort of put your cash in for the moment, we think.
This is great, John. John, I want to thank you for your time today, folks. This was John Kim, co-founder and CEO of Reckoner Capital Management. Again, that ETF, Reckoner Leverage AAA CLO ETF, ticker RAAA. Thanks, John. Thank you all for joining us today, and we'll see you on the next ETF 360. See you next time.